Hello, my name is James, and I'd like to share the latest updates from international markets. World stocks started the week on the back foot on Monday, slipping to two-week lows on further signs of accelerating inflation, as well as tax and regulatory pressures on the world's biggest companies. Equity markets are down so far in September after a 7-month winning streak, pressured by inflation, which may prove less transitory than flagged by central bankers, persistent, and signs that governments are keen to get more tax from companies and to make them toe a stricter regulatory line. After Wall Street's worst run since February, futures hint at a firm opening and European shares also rose. However, MSCI's World Stocks benchmark slipped 0.2% and an index of Asia-Pacific shares outside Japan lost 1.2%. The latest source of worry is a Financial Times report that Beijing is aiming to break up Alipay, the payments app owned by Jack Ma's Ant Group. The report, which pushed the Chinese blue chip index 0.5% lower, shows there may be no let-up in the regulatory clobbering Chinese firms have received this year. It follows a Friday court ruling on Apple that hit the iPhone maker's shares, while more reports emerged at the weekend that US Democrats are mulling proposals to increase taxes on corporations and the wealthy. Adding to concerns is the continued acceleration in inflation, with Japan reporting wholesale prices at 13-year highs last month. That comes on top of data showing factory gate inflation at more than decade highs in the United States and China, pressuring firms to pass on price rises to consumers. A market gauge of Eurozone inflation expectations rose to its highest since mid-2015 on Monday, in a further sign that investors' perceptions over the direction of future inflation is shifting. Investors will pay attention to upcoming Chinese data on retail sales and industrial output, which could show a further slowdown in the world's second biggest economy. US consumer prices, due on Wednesday, are also seen easing a touch, albeit to a still high 4.2%, while the spread of the Delta COVID variant may have softened retail sales. Banks continue to flag caution. A Deutsche Bank survey found market players expect a 5 to 10% equity market correction by year-end, with COVID and inflation seen as the main risks. BNP Paribas, while expecting the S&P 500 to stay unchanged by end of 2021, highlighted risks from higher yields and taxes, at a time when earnings momentum has slowed from excellent to good. They also lowered estimates for emerging markets stemming from Chinese policy risks. Treasury 10-year yields, currently at 1.33%, posted their third weekly gain last week, the longest streak since mid-March, and tension will likely build before the September 21st to 22nd US Federal Reserve meeting. Oil prices were at one-week highs, above $73 a barrel, due to shuttered output in the United States, the world's biggest producer, following damage from Hurricane Ida. Economic growth worries, however, have been seeping into the market, with producers group OPEC expected to cut its forecasts for 2022 oil demand. Don't miss tomorrow's news about investing and economy. Have a great day.